This is the current federal tax developments for the week of November the 10th, 2025. Current federal tax developments are brought to you by your State Society of CPAs. I'm Ed Zollers, and we're going to talk about what went on this week, November the 10th, 2025, starting out, looking down at, all the neat stuff we have going here now that we're in November. And what we're going to talk about this week is we have yet another, but this time by a Circuit Court of Appeal, a look at these conservation easement valuations, the highest and best use issues. And if you thought maybe the courts of appeal were going to get, be a little nicer on these things than the tax court was being, at least for the Sixth Circuit, the answer appears to be no, it didn't really work out better. By ending up in the appeals court, it went just as bad. I will say I think this was rather bad facts case for other reasons that maybe didn't make it the best case to take forward. But it is kind of tough, to be totally honest, finding a lot of the cases we've seen recently to find one that looks like good facts. And I'm afraid that there may be cases that could get swept up where highest and best use choice actually made sense the way they did it. But unfortunately, we have all these bad fact cases that are simply making it just a matter of law that, how you have to look at highest and best use is going to never consider a theoretical business, or is going to effectively become that true. I'm going to talk about an issue about the trust fund recovery penalty and how that was applied in the case. We're going to look at a state residency case here for California. And more importantly, to discuss when a state claims that you were a resident of that state, why you've got to recall that you have the burden of proof, showing that you're not generally the resident of the state. It's not simply, well, I'm not a resident, I wasn't there, tough luck. It's like, that's probably not going to work. I'm going to talk about some information reporting transition relief on the One Big Beautiful Bill Act for employers. Not clear how employees are going to work this out for 2025 returns. But, we'll get to that, I guess, later when we get to the 1040s. We will briefly discuss the oral arguments this week on the tariffs. The Supreme Court held their oral arguments. They went on for over 3 hours, so it was not a short oral argument. Usually oral arguments are under an hour, so it was one of the longer ones out there. But we'll talk about at least the issues that were raised. As I would always question people when looking at oral arguments before the Supreme Court, it is a bit of a dangerous game to assume you can read the tea leaves. There are various reasons why a justice might ask questions or pose certain things. And it may not just be that you're hearing the judges, or I should say the justices' preordained decision as to how they're going to come down. That saying, most observers did not think it was a great day for the administration, shall we say, in this case. There are other routes they have to get tariffs in place, but it looks like the set that's in place now could be in trouble under this structure. And finally, we're going to go again with conservation easement, timing, and penalty issues. A little bit about that, but we'll get there. So let's start about basically the best use. And actually, I should say that last one is a Sixth Circuit case. This is another conservation easement. This is Paul Adams Quarry Trust, basically versus the IRS. Taxpayer decision 2025-112, issued on November the 3rd. I forgot I had two of these cases, and the Sixth Circuit is the last one, not this one. So what is happening here again? Again, we're looking at these conservation easement cases. And the tax court's looking at the proper valuation of a qualified conservation contribution under Section 178. As you should be aware, normally you cannot get a contribution deduction for giving a partial interest in an asset, but qualified conservation easements are one of the exceptions if you meet the requirements. And generally, a qualified conservation easement is when you grant a conservation easement, meaning usually preserve. It could be preserve the, natural status of a wilderness area. It could be preserve a facade on a building that has historical significance, etc. You grant that right, what's going to be the easement to the charity, and the value of that easement, which generally is done by using a before and after calculation. That is because there really isn't a great market in, historical conservation easements per se. Rather, what we look at is what was the value of the property, the value of having the whole thing. What was the value of that property prior to the easement being granted? and what's the fair market value immediately after it's granted. The difference there, the reduction in value, is generally treated as being the conservation easement value. Now, the fun part is, how do you get to the before and after? Before and after generally takes a look at standard valuation principles. Now, one of the principles you tend to use when we're looking at land, things like that, buildings, etc., is we're looking at the highest and best use. What is the highest and best use of the property? And we're going to use that and value the property based on that. Especially with raw land, that'll be a question, because usually, the value of it's going to be, well, what's it going to be used for? And we take a look at the highest and best use. Now, where the fights come has been that we've seen a lot of these conservation easements that have been marketed that basically go to a very aggressive theoretical business that doesn't currently exist on the property, or in fact, might have even been tried on the property and failed. Okay. In this case, the taxpayer claimed the highest and best use would be an active granite dimension stone quarry. And they claimed a deduction of $10,234,108 for granting that easement. That would be considered the difference between the value of the property before and the property after. Now, this case is unusual because there actually had been quarrying done on this property by the taxpayer. Not going to help in this case, though. The taxpayer and his then partners, were basically, or the partners were seasoned granite industry businessmen. They had lots of experience. They had previously abandoned quarrying efforts on the property in 2012 after they incurred significant losses. They couldn't make money due to various factors by doing a quarry on that property. And again, these were people that had experience and background in the industry. So they had tried, they couldn't get it done. There are also people who you would say, therefore, by extension, who, if it was somehow now profitable to do so, would know how to do so and would be able to get that out of the land, which probably made the court a little more skeptical too, but we'll get there. Okay. Now, as I mentioned, you value using before and after, looking at the property's highest and best use before and after the grant. If somebody was coming in, a third party was coming in to buy this property, they would have a use that they expect to be using it for, and they would determine how much they're going to pay based on that use. The theory being is, I'm looking at how much could I make if I have that property, and I'm going to base my price, the maximum I'd be willing to pay based on that highest and best use. Theoretically, the seller, understanding the highest and best use as well, is going to raise their price if they know that, what's the best use of this, what's the most it could make off of it. That gives us the highest and best use. But however, the highest and best use you have to show must be physically possible, legally permissible, and financially feasible. As you may guess, in this case, that third category is going to cause a little bit of a problem. The valuation cannot rest on, to quote, events not fairly shown to be reasonably probable that constitute mere speculation and conjecture. The court in this case, was citing the case of Olson versus United States. Now, the court found that the taxpayers' discounted cash flow analysis, which is what they used to value this, they valued the cash flow from this theoretical quarry operating on the property. It was unrealistic, unreliable, and unhelpful. It rested on the faulty presence of having an active quarry on the property, which clearly did not exist right now. The taxpayers' experts projected production volumes that the court said defied credibility. They required this quarry to get 10 to 22% of Georgia's total dimension stone market in the early years of it, despite there was a relatively flat market conditions. In essence, there was not a shortage of supply of this stuff. So how are you going to come in, get, basically take what will be a very, very significant part of the market when the market's not exactly, unable to support itself now? It's been a flat market. There's not been increasing demand for this stuff. The current supply is more than adequate. How are they going to yank all this control? So they concluded that this proposed active quarry use was simply too speculative and risky, And a buyer would not be using that. You couldn't expect to find a buyer that's going to say, hey, that's what I'm looking to do, right? And be willing to pay the level of prices. In essence, you're just not going to have, they're going to figure out that there's not a lot of other people here bidding, based on this theory. Could be because everybody else knows what they're doing. So in essence, you're going to be able to keep the price down. Now, that was looking at discounted cash flow. They said, look, an operation here just couldn't get the volume necessary to justify the cash flow numbers you guys are showing, the net cash flow numbers would make sense. But then they went back and said, is this really the highest and best use? And now the fact that the taxpayer had been unable to profitably use this as a quarry came back to hurt them, right? In essence, the fact that they were experienced quarrymen, they knew what they were doing, and they were unable to make a go of it. Now, yes, it was 12 years ago. Well, 12 years ago now, not the year that it was donated. So, it was a few years earlier, but still, there really was nothing that explained why it would work now when experienced quarrymen had been unable to make it work in the past, right? They also said the taxpayers' geological experts did not establish sufficient confidence in the stone quality or quantity or quality to meet current standards without extensive additional drilling and testing. I mean, you were guessing. They said they really didn't do enough work to say it's there. And we know that we had a problem, a few years ago trying to do this. These same taxpayers. You see how the story starts to kind of fall apart. We get here. The court determined the highest and best use was for potential mining following more extensive drilling and testing, creation of a mine plan, and creation of a market feasibility study. A buyer is not going to assume the mine's going to work, right? They're going to discount. They might give you a bit more than they'd give if there was no chance of there being a mine there, but they're not going to take it as a given it's going to be the perfect thing, which of course is what happened with the valuations. Everybody assumed to be the perfect thing. So the court rather adopted the comparable sales approach provided by the IRS's expert, and that resulted in a rounded before valuation of $985,000. As you might guess, an easement is not going to be worth $10 million on a property that is worth as a total less than $1 million. That's going to be bad news for the taxpayer, and obviously it was. The court concluded the correct value of the easement was $612,000. The $985 before the easements on the property, $373,000 after. So it's a $612,000 contribution, not a $10,234,108. $10,234,108. Get the whole total out there. Contribution. That was way in excess of the correct value. Right. So what they're saying is the claim value exceeded the correct value by quite a bit. And this discrepancy constituted gross valuation misstatement under the Internal Revenue Code. So see, 200% would have been $1,224,000. Once you go above that number, there's an automatic 40% actually related penalty imposed on the tax benefit you received from claiming that deduction, the excess deduction. And the problem is this penalty, as we've discussed earlier, you can't get it waived for reasonable cause. There is no reasonable cause defense for this valuation penalty, for this penalty under 6662. There are for others, but not this one. So that means even if it had been considered reasonable, even if we had assumed that even if they could show that basically they had acted reasonably, they had tried to get the right number, they didn't have reason to know this was wrong, which I think would have been a tough standard to meet anyway. It's irrelevant. More than 200%. It's more than it was more than 200% wrong. It's exceeded 200% of the correct value. So once that went $1 above $1,224,000, the 40% penalty was automatic. This is yet another case. Now, this, as I said, had its own unique bad facts. It was not, however, a marketed. So it wasn't a syndicated conservation easement, but it was based on, the same theory that goes behind a lot of those. So Yeah, it went bad. I mean, it just, like I've said, you got to sit back sometimes, just ask yourself, is this credible? Why in the world would these people who knew how to do this, who knew the value, why in the world wouldn't they just sell the property? Again, but we'd have to pay tax on the capital gain. You're still going to have more money after you're done by selling it, getting the cash, paying the capital gains tax, and pocketing the leftover. Then you're going to have the tax benefit of the deduction is not going to pay for, how much cash you won't have. Because again, it would have been capital gain, so it would have been a lower rate. It's just the problem is it just doesn't work. The rational reason why you do this is because you can't sell it for that amount. Knowing there's no way to sell it, that maybe you might have trouble getting $1 million for it if we sold it, then suddenly the benefit from the deduction looks a whole lot better. And that's how the court's going to look at it. They're going to say, look, you're kind of just betting on this. The way it finally makes sense is if it's really worth far less than you're claiming. So if you sold it, you'd have far less cash. Then you're going to save by the deduction. That always looks bad. Next up, we're going to have a trust fund penalty. This is always interesting because we run into clients, who don't understand. This case is United States of America versus Flame. It's from the Eastern District of the U.S. District Court for the Eastern District of Pennsylvania, filed outright. Case number 5:25CV01498. Decision was issued on Halloween, October 31st, 2025. So what happened in this case was the IRS was attempting to collect a trust fund liability penalty from Ms. Flame. Now, the district court analyzed the standards for applying the penalty under Section 6672 of the Internal Revenue Code. And to establish that liability, the government had to prove two things, right? Simple rule. Under 6672, the government is able to collect the unpaid trust fund taxes. And remember, the trust fund taxes are the portion of taxes withheld from the employee's wages. So that means federal withholding tax and the part of the FICA and Medicare taxes that are paid from the employee's paycheck. It does not include the employer's portion of the FICA taxes, nor does it include any part of the FUTA taxes. Now, I should add, most states have a similar set of rules for, state withholding taxes or anything that's withheld from the employee's paycheck, and quite often for any sales tax or similar type of tax that is imposed. So these things sit around. The problem is, if you are deemed to be a responsible party, which does not even technically require you to own any part of the business, you can be personally liable. This is something that every person who is in accounting and industry gets anywhere near making decisions on who gets paid really needs to understand. This is the background. So what do they have to show? The government's got to show that the person they're trying to get the money from was a responsible person. We'll look at the definition of that. And then secondly, they've got to show that the failure to pay the tax was willful. Now, as we're going to discover, willful does not mean you knew they would never be paid. Willful does not mean you didn't have what seems to most people to be a good reason to pay something instead of paying the trust fund taxes. Willful just means generally that you had the ability to get the taxes paid and you allowed somebody else to be paid. We get to the rough definition there. Now, they were trying to come after $204,446.54. Can't forget the pennies for unpaid unemployment taxes, or actually unpaid employment taxes, not unemployment taxes, from two related entities. So she had two times she was involved with businesses. They both failed to pay trust fund taxes. Now, part of the reason why that happens, and I do think this is a huge problem, is that, we all hear the stories about the IRS being horrible, terrible, nasty, coming after people, and clients think that, the minute they owe the IRS $2, somebody's coming out to throw them into Leavenworth. But actually, the problem's the opposite. The IRS is known to let these things just keep growing. Quite often, the reason why people have big problems with the IRS and back taxes is because, they have financial issues, they're having trouble paying bills, and they notice that nothing seems to happen. When they don't pay the IRS, if they don't pay the utility company, people turn off power, right? You don't pay the landlord, eviction proceedings start. You don't pay your car payment, they take the car. But you don't pay the IRS, and for a while, nothing seems to happen. So guess what? I have worked over the years, known people over the years that have trouble, get behind in paying all the time. And they tend to react to the fire that's the most demanding right now. So the minute these guys aren't on them, when the IRS does not have somebody calling the day when they're 30 seconds late depositing payroll taxes, suddenly they become the less important person to pay. And that's what tends to open this up. So let's talk about her position. For the visiting nurses, and we got two different companies here. One's we're going to call visiting nurses, the other home care. She served as the assistant administrator and business manager. She was one of two people in the organization authorized to approve payroll and possessed the PINs and passwords for electronic payments and bank access. So she had the ability and she had the power to approve payroll, approve payments, and pay things from the bank. For home care, she was the sole member of a member-managed LLC. She was in charge. She had full authority over all financial affairs. She was the only person that had signature authority over the bank account. The court found that in both cases, she had significant control. Because the test for being a responsible person is, did you have the power? Did you effectively have the power to do this? And the test is, it doesn't mean you own it, because remember, in the first case, she was merely the assistant administrator and business manager. She wasn't the total owner of the entity. She was there. But the problem was that in her position, she was one of two people authorized to approve payroll. So she could approve payroll on her own, right? And she had the PINs and passwords to make payments. So she had the authority to make payments. That authority is the issue right now. That made her a responsible person. She had the power to get payroll taxes paid. That doesn't by itself mean she's going to owe this, but it is the first step. Had the court found that she lacked the power, let's say that she was like, a very low-level accounts payable person who had absolutely no authority to release bank funds, had no authority to approve payrolls, didn't have access to it. Yeah, that person's not a responsible party. So bingo. On home care, again, she controlled everything. She had full control. You're 100% owner. You're always going to be a responsible party. The question is going to be, can they show willfulness? And that's going to be the issue. But her significant control meant that she had over visiting nurses and final word over home care's payments. We take those facts supported by depositions submitted in the case and the forms 4110 that have been filed. They established she was a responsible person for both entities. Again, that doesn't mean she owes the penalty yet, but it means that basically, we have now gotten the first domino has fallen, or the second one going down too. Now, willfulness, that standard is either a voluntary, conscious, and intentional decision to pay other creditors of state of the IRS. You knew money was owed. You knew trust fund money was owed to the IRS. You made a decision to pay other creditors before you paid those trust fund taxes over. That would establish willfulness. But I did that because they were going to lock my doors. The landlord was locking my doors and confiscating my inventory. If I didn't pay them right now, it's like, well, tough luck, right? When you pay them, as I would tell anybody who's responsible party, which can be a controller in the business if they have sufficient powers, I'd say, well, you just said, if for some reason we can't pay these trust fund taxes, I understand I'm going to pay them to you, IRS. Phrased that way, you find that the controller is no longer as worried about losing their job as they are about the fact that they are beginning to realize this company is not likely to last. There's a good chance this money will never get paid. And, they're not about to write checks personally in the future and basically have this hang over them. Now, it's better to bail. I hate to say it, but if you're a controller, it's better to bail at this point. I have known controllers that have decided to hang on companies that, come on, if you're realistic, it's going under, but you just want to get through this week and get this paycheck. And that paycheck can cost you a lot. It can cost you, in certain cases I'm aware of, the trust fund penalties. You have that coming back at you now and having to deal with that, after the company failed and you weren't an owner, but, you look more collectible. So they're coming after you. They can come after multiple people too until they get it. So, they'll just include you. Or, worst case, when other issues are going on and other types of things are happening internally, one case ended up in prison time for the controller who didn't own any of the company. Because in order to preserve the job, did various things because, didn't want to lose that paycheck, was ordered to do it. I'm just following orders doesn't work, guys. Right? That's it. I'm just following orders doesn't justify you committing a criminal offense. I'm just following orders here also doesn't necessarily work well. We'll get, in essence, there are times you say either we're paying this or here's my resignation. I'm walking out right now. I am not going to be involved with getting anything else paid unless the trust fund's taken care of. The other side of this is called reckless disregard that taxes are going paid. And that fact pattern usually works like this. Okay, I became aware trust fund taxes weren't paid. I'm a responsible person. I became aware of that. I did, I talked to, the parties, because let's say, well, I have the power to, I don't normally approve the payrolls. I have the power to do so. I could sign things off, but I don't normally do it. But I became aware of the problem. So I talked to the people. Maybe I talked to my partner in the business. My partner assured me that the unpaid trust fund taxes were going to be taken care of today and that they would never get behind again. And I trust my partner. Bad move. Because once you're aware there's liability out there, there are two real requirements you have going forward. Number one, you make darn sure that shortfall is fixed as soon as possible. If that's not happening, because you have the power to fix it, now you got a problem. But number two, I need to keep my eye on the trust fund payments going forward, knowing that, those other parties, the ones that just assured me everything be taken care of, knowing that they in fact failed and let it go unpaid in the past means I now am on notice that they might not get paid in this organization. I now have a responsibility to check on them and make sure they're paid. Right? And like I said, if there's any other creditor paid, including wages with knowledge that the trust fund taxes are due, that's going to be considered. And in this case, the court quotes a couple of cases, Simango and Greenberg, or there is a reckless disregard as failure to investigate or correct mismanagement after being notified of unpaid taxes. And that was also, Simango mentioned that as well. And the key thing, this is where people always come in. This is when, which is sad because I've talked to people and the first thing they tell me is, well, financial distress or spending money to keep the doors open. Even if you legitimately think you're going to have later revenue to fill it in, by the way, they're wrong. If they're talking to me about this, they didn't get that part right. There weren't future funds. It's so easy to convince yourself that the problem is just temporary and it'll all be solved next week. Now, while sometimes the plan, weird as it is, to solve things does work, there is the story, which I believe is correct, about how FedEx was at one point almost ready to go under. And, the chair of it took the remaining case. They had to pay fuel. They were so bad at paying people that they were now on cash payment for fuel to fly the plane. And I guess a couple of planes, whatever they had, and they didn't have enough money to pay for it, to fly, the next set of flights. So apparently the story went, he went down and gambled, right? Took the entire cash account because it wasn't going to be enough to pay the fuel. They're going to be shut down. Gambled it all. Went down and played. What was it? Was it poker or craps? I forget which one it was, but it's like, but anyway, he won enough to pay the fuel. And after that money did come in, the cash flow crunch was eased. Everything works. Yeah. Unfortunately, he had a better shot of winning than 99% of people I talk to who have gone down this route and thought the thing would be paid off. No, you were wildly hoping for a highly unlikely result. The FedEx story is a better story, right? It makes more sense. It was more reasonable. Still probably would have had some problems with the investors who wondered why in the world you thought that was a valid way to do it. Had you not gambled, at least we could have gotten a little bit of cash back. Right. But, as things go. In this case, Flame was aware of the deficiencies for visiting nurses starting in 2014, yet she kept authorizing payments for operational expenses. And for home care, she was notified of liabilities in 2018 and 2023, but continued to pay operational expenses, payroll, and her own personal compensation out of the entity. That looks bad. You're paying yourself, but not the IRS. That's never going to look good, right? Since she failed to rebut the legal presumption of correctness afforded to the IRS's assessment and did not dispute the facts of responsibility or willfulness, IRS got summary judgment in this case. Ms. Flame, you owe them just under $205,000. Bad, but kind of expected. That is not all a surprising result. I'm sure she hoped for the better, but it's like, to me, it's like that's. You bet. I don't think I would have. I think I would have suggested. I don't think you got a real good chance here going to court. I just don't see a court. Maybe there's an outside chance you'll find a district court judge because they don't usually do tax who might agree with you. But then you just got the risk the IRS decides to take you to the appellate courts. I don't see how you're winning there at all. So that's your problem. Let's talk about next a person that said, I'm not a California resident. This is in the matter of the appeal of J. Lunt, the California Office of Tax Appeals, case number 23-0112-468. Now, the opinion came out September 4th, but I think it just got posted to the web here recently, which is why we now have this case to work with. Let's talk about what was going on in this case. Okay. Now, here's the catch. Remember, you're going to be facing the legal process of the state in which that claims that you're a resident of that state. So in this case, you're going to be facing, in this case, the California Franchise Tax Board will be the ones that would be, taking the position you're a resident and making that determination. And if you're going to challenge them, you're going to have to go through the California process, which routes initially through the office, the Office of Tax Appeals. I think that's the OTAs. They renamed it a couple of years ago. So OTA, I've seen it. I've always seen it does that. I think Office of Tax Appeals is the official name, but it used to be a different name. California will tax their residents on their entire income, regardless of source, and taxes non-residents based solely on California sourced income. That's true of virtually every state with an income tax, right? If you're a resident, we tax worldwide income. If you're a non-resident, we tax only income sourced back to the state, right? So we want to look at sourcing. So what they're trying to say is not just, we don't just want to tax your California sourced income, we want to tax all of your income. Now, he didn't file a timely 2018 California return because, and appears to be correct, he felt that he had no California source income. Now, what happened was, though, the FTB got, basically through the Employment Development Department, I have to give the right names for agencies in different states. It always gets weird because they all call things different. There had been a W-2 filed showing California withholding for him, and there was a 1099 for retirement plans that showed California withholding. Based on that, and some other information, they basically assessed him $12,315 in tax and a $3,078.75 late filing penalty. Now, if the taxpayer fails to file under California law, Revenue Taxation Code Section 19087A, they're authorized to basically estimate income and propose an assessment. The initial burden of the Franchise Tax Board is relatively low. It must show the assessment is reasonable and rational. It met its burdens by using a W-2 and 1099, showing California tax withholding and California income exceeding the statutory filing thresholds, which was $47,188 for joint filers over 65 in the year in question, 2018. Once this minimum foundation was established, I have payors of income who are saying this is California source and only said that but withheld California taxes, and it's more than the minimum to file. Now, suddenly, the assessment is going to have a presumption of being correct. This is really kind of where the taxpayer is going to get in trouble here, because the taxpayer believes this is absurd, right? But just saying it's absurd is not going there. You now have the burden of showing you're not a California resident. And that's going to be a problem in this case, what we're doing. The taxpayer has the burden to prove errors by a preponderance of the evidence. Now, the taxpayer protested, asserting he was a Montana resident and had no California source income. He claimed the withholdings were erroneous. I have actually seen that. In one case, I had a client who was like a regional manager for a large publicly traded company. And suddenly, in the middle of a year, his employer started withholding, instead of Arizona tax, New Mexico tax. Well, he didn't meet the standards to be an employee in New Mexico. There was no reason there. He had never asked for any changes in withholding. Nothing had changed, just somehow during a switch in payroll systems, some update, he suddenly got swapped over randomly to another state in his region as being where he was going to be sourced from. So it does happen. The withholding can just be wrong. And if you've ever dealt with a large organization, trying to get them to admit they fouled up, and the big problem is because somebody realizes we would have to amend the W-2s and nobody wants to do that, you may have a problem. So he's saying it's wrong. Now, he does have maybe a bigger problem because it was both W-2 and 1099-R, but, employer's plan, very possible that really it's the same error, right? The problem is he failed to provide sufficient substantiating evidence to show that he lived in Montana, not California. Documentation, he had none. He didn't provide what could have been useful documentation, contracts that tied him to Montana, an employer statement showing he was working in Montana, right? So he failed to show that that was earned while he was a non-resident, or that his services were even performed outside California. Remember, he didn't file any return, so even if it was California's source income, but he was a non-resident, they still would have taxed that. He failed to show any of that. He also failed to explain the number of days he resided as a Montana resident versus, and this is a problem always, he had a California address. And he didn't tell how many days he was at each. And there are all kinds of other ways. California, like most states, looks at whether you have established, in essence, your residency is established generally by your connections to the state. Do we meet the requirements here to be more closely associated with that state than another? And, he had been, and this is usually where the problem comes, he had lived in California, but now he claims he had really, really permanently moved to Montana. But one of the big problems we hit is they inevitably hold on to the old residence, or hold on at least some property in the old state. And that's a bad move. Other bad moves is you never update your driver's license, so your driver's license is still from the old state. never update your voting location, so that still shows the old state. You basically are still like, let's say you have a membership in a gym it's in the old state, not in the new state. You also are making significant charitable contributions. Let's say you're a member of a church. While you may attend church both in California and Montana, you're making the bigger contributions to California. You seem to be more involved in the California church. Your mail mainly goes to California. You get all those facts, it looks bad. So the key is showing your domicile. And to change domiciles, most states are going to require two things. And domicile is a weird common law theory of essentially what you can vaguely say is home, where I think of as home, and where even if I'm away from it for a while, I plan to return. And you do not establish a new domicile. You don't get rid of your old domicile until you establish a new one. So what he really needed to do was show, A, that he had taken steps to abandon the California domicile, but B, that he had established a domicile in Montana. Because if he hasn't, then he still could be caught on the domicile. While that's not totally fatal in California, it's going to make it much more difficult to avoid it. Bottom line, the Office of Tax Appeals determined that the taxpayer did not satisfy his burden of proving an error in their income sourcing or their residency. So, sorry, guy, you owe taxes, resident return, you owe it on all worldwide income. The penalty for failure to file by the due date, unless the taxpayer demonstrates reasonable cause and not willful neglect. As with the others, the penalty is presumed correct and requires the taxpayer to provide credible and competent evidence to show reasonable cause. He never filed a valid return. The maximum 25% penalty had already accrued by September of 2019. He failed to provide any distinct reasonable cause argument, relying instead on saying, I had no California source income, which to a certain extent wasn't necessarily the argument, right? Again, no California source income could still not get you out of this if it's found out that you still were keeping your close connections in California and had never really given up the California residence and were actually spending more days there than you were in Montana. So it could be there. Now, California is probably the second most active state in terms of pursuing, in my experience. New York being the most active. But still, the same problem is going to come up with any state when residency becomes a question. You need to understand clients. I remember, I had to tell a client recently, like, well, you know what? I know he's a hunter. Did you, when you got your hunting license, let's say for Old State, and of course, still had property up in Old State, his Old State. When you got your hunting license, did you get a resident license? Yeah. They cost so much more if you get non-residents. Like, guess what? You got your resident license with that state. That state government now has on the record that you claim to be a resident of that state. Yes, the revenue people will use that against you. So, you got to kind of be careful about that consistently. People love to have floating ideas about where they really live. That varies depending upon the context of, well, if I'm paying the state where I'm going to pay less. If I'm a resident, I'm a resident. But when I'm looking at the taxes, I'm a non-resident. Yeah, you're going to have to get consistent, guys. You got to decide which is the lesser poison. And as I tried to explain to this person, I strongly suspect in your situation that getting a non-resident hunting permit is likely going to be the far cheaper option than paying taxes to Old Home State on all your income. Transition relief. We've been asking for this. We got a partial on it. This is Notice 2025-62, November 5th, 2025 came out. This is on the various OBBBA subtractions that are payroll related. Okay. This is a penalty relief for tax year 2025 only. 26, this will not apply. We already have the draft W-2 for 26. You're going to have to report a lot of these details on the 26 W-2, which means you better start getting ready and your clients better start getting ready, figure out how they're going to capture the information. So this targets relief for failure to file correct information returns under 6721. And under 6722, the failure to furnish correct statements to payees who you're supposed to give the information returns to. New mandates are tied to deduction for qualified tips and qualified overtime. Okay, qualified tips and qualified overtime. Remember, quick summary. For qualified tips, those are going to be tips received that meet all the statutory requirements of new Section 224 of the code, which means they are cash tips. And we know that's not just, basically currency counts, but also counts for tips on credit cards, various other stuff. Pooled tips accounts will count too. What wouldn't count is if it actually gave property. It also, must be totally voluntary on the part of the paying party. So those mandatory gratuities for groups of 6 or more, those will not be things that those who receive those tips are going to be able to subtract out under the 25,000 max limitation. It cannot be subject of negotiation, cannot be received in a specified service, trade, or business. And it must be received in occupation that is on a list, which we now have the proposed reg list version, so probably what we're going to see in the end, of occupations that prior to the end of 24 had traditionally received tips. Okay? And the employer is required to identify what were the tips that were qualified tips received by the employee in their W-2 that would be eligible for this subtraction, assuming they meet the income limits. And number 2, we have to tell them what occupation they're in, their qualifying occupation. You have to tell which one that is. Okay. For qualified overtime, that gets tricky because it must be FLSA overtime. Only overtime required by the Fair Labor Standards Act federally. There are some states, California is the extreme example, that have much more strict overtime rules. If you're a California accountant, you're doing payroll, California overtime is not going to be what they get to subtract. You got to go back and figure out how much of what they got that week would have been paid out as FLSA overtime, and specifically limited to 50% in excess of the normal they receive for those extra hours. California requires overtime every day an employee works more than 8 hours. Feds measure weeks. You get more than 40 hours in a week. So if somebody works 3 days and works 9 hours a day, under California law, they would get overtime. Under federal law, they wouldn't. It's not they couldn't pay it. The company can pay whatever they want, but it wouldn't be considered required overtime for which the subtraction will work. Neither can you use double time if you pay double time instead of time and a half, because federal law requires time and a half. And also the Wall Street Journal pointed out, and I haven't really verified, but I'll take their word for it, that many people in the transportation industry are covered by a different federal law that mandates overtime, meaning that arguably they can't take the subtraction either. There's all kinds of neat problems in reporting. And as I told everybody, probably, especially like you pay extra to people who work holidays, you have a union contract, or you're in a state that has different rules, probably your overtime is not really going to be the qualified overtime. You're going to have to come up with a different number for qualified overtime. So even if you're tracking overtime, you think right now, you're going to have to also track FLSA overtime. How much that overtime would have been paid for FLSA, and make sure you're not paying more than 50%, right? Only that 50%, the excess counts. Now, as I said, the reporting changes that technically were required for 25 but are being deferred for a year. For qualified tips, you would need to provide a separate accounting of reasonably designated cash tips and their occupation on their 1099 or W-2 that you issue them. And for qualified overtime, you'd have to provide the total amount of qualified overtime compensation on forms W-2 and 1099, which again has to meet that FLSA rule, and meet certain other requirements to make it work. Now, we will have a different threshold next year, though. That is important to realize in 26, right? We are going to increase our threshold for the 26 W-2s and 1099s from having to do them with $600 or more paid to $2,000 or more paid. So keep that in mind, too. We got that coming in. That isn't really impacted by this because that's not going to take effect until the 1099 is going to issue in early 27 for 26, but it is there. Now, the IRS said, we recognize that right now payers and employers likely lack necessary data, systems, and procedures to completely accurately reply with this new reporting. But remember, 26, you're going to have to do it as it stands right now, and there are penalties for not doing it. The IRS announced that Form W-2 and 1099 for 2025 will not be updated to reflect these, OBBBA-related data fields. So therefore, 25 has been designated by the IRS as a transition period. They pulled this more than once. And what I find amusing is Congress whines about this, but only if you're in the party that didn't vote for this. So expect to hear Democrats whining now about the fact that the law said they were supposed to do it this year, but now the IRS illegally is, saying that you guys all get away with this. Okay, well, there's no reporting. So what they're saying is this year they will not impose penalties under either the failure to tell the IRS or failure to tell the employee, failures relating to providing the separate accounting of tips, occupational description, or separate accounting qualified overtime compensation for 25 to the IRS and to the employee. As I said, the reason I point out there's going to be screaming, and I wouldn't be surprised to see Democrats do it, is I suspect this is going to cause some problems with people trying to fill in their returns this year. The employer is going to give them this information. And we had that same whining, and I think it's justified. The problem is Congress passes impossible deadlines and then just figures the IRS will fix it. Because that was done to, remember, at the 109K, and keep pushing that and keep, extending when that would apply, even though the law clearly said applied many, many years ago. Now, I do admit that kept going for a few years, but the complaints started immediately. The idea was they were going to push it past an election. Then they're going to push it past the next election, right? Then they're just going to force it to start happening while the Republicans are in office. It's like, okay, this is the issue. But the IRS, unfortunately, has a long history of not necessarily, when the Congress says you'll do this beginning of this year, industries have now gotten used to whining to the IRS and getting things pushed back. So it happened again. And it is going to be a problem, I think, for employees unless the IRS gives us some more relief, right? It is strictly for returns and statements for 25, will not cover 26. Only to fail to separately report the new data, not to fail to file W-2s or 1099s at all. That's not going to get you out of it. You must otherwise file and furnish a complete and correct statement, in this case. Cash tips compensation must still be included in aggregate payments included on the box one of the W-2. So other items must be right. And this is where we got a little concerned about this. Filers are strongly encouraged, though not required for penalty relief, to provide employees payees with the necessary information, occupation codes, separate accounting, through secure methods to aid the taxpayers in claiming their deductions. So now, I think most employers will discover they're not going to be as worried about the IRS as are all the employees whining and complaining. So I would say probably work up a way to get here. But I also know that some companies will say, well, we can't get the right number. We can't get the right number. We're not sure it'll ever be right. So we think that's a legal liability if we do that. That's why we need the IRS to give some relief for the employee. They haven't. Can they say an employee can reasonably rely upon, unless they know it's flat out wrong, the statement they receive from their employer? I wish they'd do that, but they haven't yet. So keep an eye out for that. Next up, what got in the news this week? Remember, we had oral arguments on the IEEPA tariffs, the Learning Resources versus Trump case, U.S. Supreme Court case number 24-1287. We had oral arguments held this week on November the 5th before the United States Supreme Court. Okay. Now, the key question that's before the court is whether or not the president has the authority under the International Emergency Economic Powers Act to impose tariffs on his own. The question is the statutory interpretation of the phrase regulate importation, but also constitutional doctrine, right? Whether or not, can Congress delegate permanently this way? And what's the limit of delegation, right? So there were three primary areas they were concerned about. What did the text say? And did the text authorize, imposing the tariffs? What about the constitutional doctrine, the major question doctrine, and the non-delegation doctrines, right? Because the Constitution very clearly limits the power to tax to Congress. Did not give the executive the power to tax. Right? It does give the president primacy in foreign affairs. But the question becomes, if this is a tax, the argument is that Congress has to be the party to impose it under basically, basically for Section 2 section of the Constitution, right? I got to remember what we call the various parts anymore. Basically, or Article 2. It is Article. Right? Okay, Article. Article 2 of the Constitution. Is this an Article 2 case, and therefore the president, Congress can't just delegate broadly. Congress can't just walk in now and say, hey, you know what? We hate dealing with these tax issues. President, you can set all the tax law. We'll just let you do it. That would be excessive under the non-delegations doctrine. And the other problem is major question doctrines is, well, does the statute clearly delegate in this case? Because under the major questions doctrine, which was a doctrine that came up back with certain actions that then President Biden had taken regarding things like, discharging student loans, where saying, you can't use vague authority for what's considered to be major questions. And of course, I figure out what that means. But I don't think anybody doubts that this is a major question. The question is, does the doctrine apply? Or should it be an exception to major questions doctrine, which is where the fight's going to come in this case, right? And the scope of executive authority in foreign affairs. Does the foreign affairs authority, override the limitation on taxation power residing in Congress? Is it normally it would not be okay, so you couldn't just delegate U.S. taxes, but you can do it if it relates to a foreign affair problem. Okay? So now what the government argued, Solicitor General argued that regulate importation is a capacious verb. Well, somebody was into their thesaurus for the night. A capacious verb that plainly embraces tariffs, which are argued to be regulatory tariffs. They're meant to be commerce control, with any revenue raised being incidental. Okay. We'll get back to some of those parts. Needless to say, a lot of the questioning was very skeptical on some of those issues, right? Now, the position of the challengers, the businesses and the states that sued, they are fundamentally taxes on U.S. citizens, right? And I guess it's Article 1. Yeah, Article 2 is the president. Article 1 is Congress, which is Article 1 power, reserved to the United States Congress. And they are different from sanctions found listed in the IEEPA, which says to block, prohibit, but never actually says tariffs or taxes, right? And Justice Sotomayor, and by the way, others hit at this too, but in her questioning, she repeatedly asked why Congress would not have simply said tariff or tax if they intended to delegate this, which everybody said is the core power that's being used. So, it's the thing they say, oh, that makes the most sense to do. Why would they have not mentioned it? Why were they quiet on it? Okay. Also, Justice Jackson noted that this bill, IEEPA, was designed to constrain presidential authority that Congress felt had been overly used under the predecessor Transactions with the Enemy Act, which we have the one case that ever got the question of whether tariffs could be done. It was under that statute. Then we get back and forth there. And as they will point out, that particular decision was kind of disputed, never really challenged up, was irrelevant by the time anybody got around to where they could have gone to the courts of appeals, so it never went up. Now, Chief Justice Roberts brought up the major questions doctrine, which is what was raised in the, basically in the prior administration. And, he's one of those involved in drafting that concept. He said, noting that the power to impose tariffs on any products from any country for any length of time is a major authority. You can't because again, remember, as was pointed out by Justice Sotomayor, it never said tax. It never said tariffs. They're just saying, well, it used verbs, and kind of we can argue these are regulatory taxes because the Solicitor General said, because basically the best tariff would never be paid by anybody. It would basically do that. Of course, then it raised the question, why don't you just prohibit imports then? You have that clear authority under the law. Why don't you prohibit them? Well, obviously saying it's a tax. That'd be the argument. Right? They also question the government's claim the non-delegation doctrine applies with less force to tariffs. They said, look, taxing power is legislative. Justice Roberts came really close to saying a tariff is a tax, period. He came really close to saying that. So we're in kind of a back and forth here where it appears there's many are skeptical on that concept. Justice Kagan, who's previously a Solicitor General, prior Solicitor General, which is kind of interesting when you get in there too, observed that IEEPA, unlike traditional tariff statutes that you find in Title 19, lacks the real constraints like percentage caps or time limits. That makes delegation problem worse because now they're claiming rights to do things that Congress itself has never done under its clearly granted power under Article 1. Okay. And Justice Gorsuch and Barrett, and important things to note, they are both justices that were appointed by now President Trump. They voiced concern that validating this delegation creates a one-way ratchet. The one-way ratchet got discussed a lot, saying to making the president more powerful. They said, here's the problem. As later rulings held, Congress thought when they passed this that they could veto any presidential action by a simple majority vote. Later court cases ruled that Congress couldn't do in a case like that. In a delegation structure, they would need to have a veto-proof majority, right? The president can veto their attempt to veto. And the only way they get to override that is traditional veto override, 2/3. Well, Justice Gorsuch and then Justice Barrett followed up with saying, look, the president inherently does not want to see his power reduced. So we're going to presume that if a bill gets sent to the president to remove this power, they're going to take it back to Congress, that the president's likely to veto it. Not going to give up the power. That means that we need a veto-proof majority, which last time Congress had veto-proof majorities in both chambers was back in the 1970s when Richard Nixon was president. And as I believe we were also in the Watergate at that time. Watergate had happened, election gone by. It wasn't good. I guess we really hadn't gotten to Watergate yet, so it may have been after while Ford was still in office. In any event, we haven't had one for ages. We haven't had one longer than many people listening to this have been alive. We haven't had a veto-proof Congress. So therefore, if the party of the president sticks with the president, you never could veto any of his actions. Right? He could do pretty much anything he wanted, make it very, very difficult for Congress to ever retrieve this power. Now, the government can see the president does not have the inherent Article 2 tariff authority in peacetime. That power must flow from the statute. We don't know if the statute can do it. Now, one of the interesting things that was proposed by Justice Gorsuch. So he said, let's imagine a future president declares that due to the climate emergency, right? Climate emergency, remember, this is being tied to a fentanyl emergency, that he is going to impose a 50% tariff on any imported parts, any imported cars that are gasoline powered. Would the president have the right to do that? Now, the Solicitor General tried to initially claim that, that climate change is just not, it's not fun. Said, no, right? Because you're kind of telling us that we really can't litigate where the fentanyl thing is an emergency. So we're just going to accept he's declared it just like your guys declared it. Could he do it? And would it be a valid use of the power? And Solicitor General didn't really have a way to argue it wasn't a valid use of the power. That's one I think that may telegraph where Gorsuch is going. Because I don't think Mr. Gorsuch really was in favor of imposing a 50% tariff on gasoline-powered cars. So he's going to basically, I'm going to guess, I'm just not, again, it's dangerous because who knows? You could have totally different. But it wouldn't surprise me to find that he's going to couch his striking down of the tariffs on the fact that it's an improper moving of powers from Article 1 to Article 2, from Congress to the president. And he's going to use exactly that sort of example. It would be an unfettered limit on the executive branch to do whatever they want just by declaring an emergency and somehow linking it to a foreign country. Because they also asked about that, which is, and why, because we got to ask the other question, well, why are we imposing tariffs? Supposedly counter the fentanyl problem, with fentanyl, the problem really being, you're identifying China and let's say Mexico and a couple other places you claim are doing the fentanyl things. But why are we also doing this for our allies who don't really have, who you're not alleging have something to do with this? So basically, once you got your emergency and it's vaguely foreign, you can then just apply tariffs to everything. As I say, it doesn't look good. Again, could be totally blown away, find out that, in fact, no, they're going to vote, I doubt unanimously in favor of the tariffs are fine. But I could see them voting 5-4, even maybe 6-3. And that we're just going to have a couple of people that were just testing things out. And they're going to go ahead and back, the current power. But if I had to guess right now, I would think we are probably getting a 6-3 vote at least to strike it down. And, very potentially, a 7-2, 8-1, even maybe 9-0. Yeah, I think this case is going to go that way. By the way, Justice Barrett, then a bit exasperated, started asking, well, you said when you told us to, hold up and not let the injunctions go in place, you told the First Circuit that the fact that, wait, you're going to keep collecting, they say, well, oh, no, there's no problem. We're going to refund. So even though they have to pay them, they'll get them refunded. He went through the mechanics of the refund process and just basically, it's going to be a mess, right? Yeah, it's going to be a mess. Solicitor generals couldn't really tell her why it wouldn't be a mess. And there's even some thought now, as a plaintiff, what I thought was hilarious, plaintiff said, well, your real options here are go ahead and say it all has to be refunded, make it a mess. Go ahead and stay your decision for a short time to allow Congress to basically retroactively approve the tariffs. Or third chance is to, essentially just say it only applies going forward. And of course, the government's kind of leaning in now the third one. We don't need to repay these tariffs, whether they are trillions or billions, depends on who you talk to. It was kind of pointed out to the court, that, wait, if a tariff that's effective would raise no money, how come we've got all this money? Right. Was that not really the purpose of the tariff? So, yeah, there is that. So we'll keep an eye on it. There are clearly other ways, which even the justices mentioned, that other statutes that may allow them to impose certain types of tariffs that would have time limits, etc. There are other ways to do this. And obviously, Congress could just impose a tariff. Because nobody says they don't have the power to do it. We just have to kind of see what's there. Okay, now conservation timing and penalties, easement timing penalties. This is the Sixth Circuit case. We have finally gotten one of these conservation easement cases up to the tax court. I say up outside the tax court to the Sixth Circuit. This is Corning Place, Ohio, LLC versus Commissioner. This is case number 25-1093 from the Sixth Circuit, issued on November the 5th of 2025. Now, this has some extra facts beside the really questionable valuation. So we'll get there. But the Sixth Circuit affirmed the disallowance of significant historic preservation and conservation easement deduction that was claimed by Corning Place, Ohio, LLC. Now, there's one additional fact in the middle of this that makes this case really weird and problematical. But the fact is, the Sixth Circuit held them to it. The problem is, for a certain period during this whole thing, including exactly when the conservation easement was transferred, Corning Place LLC ended up with only one member. But it claimed the easement on the 1065. Uh, as I tell people when I teach partnership courses, a partnership requires partners. That's plural. You have one partner in your LLC and it was being taxed as a partnership, it just became disregarded. And you might be able to elect to make it a corporation, but you can't elect to make it a partnership. So that was also a problem in the midst of all this. So Corning Place purchased a building for $6 million, and they purchased a building. They claimed a $22,601,000 conservation easement deduction based upon a hypothetical 45-story tower development. Okay? Now, timing was crucial here, and this is part of it. Donation occurred on May 25th, 2016, during a 7-week period during which Corning Place had only one member, one partner. So fundamentally, the first thing they said was, sorry, guys, you claimed it on the wrong return. There was no Corning Place LLC partnership on that date. Therefore, the partnership had terminated at the beginning of the 7-week period, and then a new partnership had been formed when you got the new member. During that 7-week period, it was not a partnership. So you've really got old Corning Place partnership, new Corning Place partnership, and then the interim period where everything goes on the return of that one partner. Right? Partnership's taxable year exists only when it has multiple partners. And this, they reference you to Treasury Reg 301-7701-3F2. One partner, you're not a partnership. That was fatal. Okay. So donation occurred when Corning Place had a single member LLC. It did not exist as a taxable partnership. They held that investment, the sole partner, was the correct taxpayer for deduction, not Corning Place, but it had been claimed by investment that directly, right? It rejected the argument this is a harmless administrative error, citing the precedent saying, for this case, form is substance, sum of holding versus commissioner. It's got to be claimed on the right return. It was not claimed on the correct return. Because of that, and because we're litigating the partnership, right? Because, this is under a partnership adjustment. I'm sorry you got this wrong, but you got it wrong. Now you're going to say, well, it all got allocated to investment only. So really it's no harm, no foul. I said, sorry, guys, we're not taking that for this. Especially when you're trying to claim us, we have to follow the law detailed and technically. It's like, you need to follow this detailed and technically. You didn't have a partnership. That's plain law. We're going to say there is no partnership. Now, it attempted to cure this, right, by submitting an amended return in September 2020 and moving the deduction to the right place. The attempted cure was rejected as untimely because the IRS already notified partners of the proposed adjustments in July 2020. And only then did somebody figure out we got a problem. And now they tried to file an amended return. You're too late once you've been notified of the proposed adjustment. So we have a problem. Secondly, okay, so bottom line, you couldn't claim the deduction because it wasn't claimed the right place. That's bad. But number two, you also, your valuation, because now worry about the valuation, not because you're going to get the deduction. Already determined you're not going to get that. But the courts have turned to pass, even if there are other grounds under which you would not have gotten the deduction, if you claim substantially more in value than it was worth, even if you hadn't had the other problem and gotten the deduction, you still would have been claiming over twice the proper value for what you claimed as your contribution, which triggers a gross valuation misstatement contribution penalty of 40% of the tax that was saved. It said it doesn't make sense here. This proposed valuation is a highest and best use, did it again. It was rejected because it has to be a reasonable probability, not mere speculation and conjecture, following the Olson case. Now, what had happened here, they had an already existing, tower that they had converted to, luxury condominium development. Now, when they're looking at doing this and doing this, okay, and when they did that, they got a separate historical preservation credit that was paid to them in order to, keep the facade and to keep the building. Now they're going to try to donate that facade and claim a deduction now under the federal rules. Well, this is one of the problems. So they went back to the architects that developed it, and they went and asked for, because, somebody approached them and said, well, you could donate that. And, and okay, it's not a problem because, you just took tax credits and you're not going to, you said this, but we think you're still fine donating the easement. You could donate the easement to, this charitable organization. And we're then going to take a look at what the highest and best use would be. If there was no easement there, we're saying the highest and best use would have been, basically changing this smaller tower into a 45-story tower. Now, the architects outlined plans to do it, but they had a lot of caveats on it, right? They had noted that if you did this, it would be structurally unsound unless a lot of things happen. And it required engineering analyses that were not to be used, right? And the required engineering analyses they did to do this specifically said you could not use that for actual construction. So nowhere did we really have anything that told us that you could do this mod to make this a 45-story building, which would add a lot more capacity. Number two, it was totally incompatible with the restrictions imposed on you when you got the historical preservation credits. You can't legally do this. Nobody could. If you sold it to them, they couldn't do it either. They legally can't do this. Right? And finally, the estimated construction costs, $102 million, were totally speculative. The court said patently speculative. So what the court said was essentially the highest and best use of this is not this 45 tower, therefore way over the top, right? In fact, we have the whole thing about whether there was any value at all because we're kind of already prohibited from changing the outside. The court affirmed that the hypothetical use failed the initial inquiry into whether it was reasonably probable it could be done. It can't be the highest and best use if they can't show a reasonable probability that it would actually could be executed. And they grossly failed that in the view of the Sixth Circuit. The tax court's alternative valuation was therefore upheld by the Court of Appeals. They saw no need to change it because they claimed a $22.6 million deduction. That was 2,500% of the correct value, meaning we're well over double. So gross valuation overstatement is there. And that also means that, the 40% penalty applies and there's no reasonable cause to get out of it. So we get it. Now, as I said, this had a couple of extra facts that we don't see in others. This one probably has one of the oddest claims that we have a valuation issue here, that we could do this development when clearly we took credits before that. That remember the old thing we always heard about, pigs get fatter, hogs get slaughtered for taxes? This is hog in extreme, trying to get this one. I'd say that probably meets the hog test pretty well because you got the historical conservation easements. You had the technical problem that you weren't a partnership but claimed on a partnership return. Yeah, there are lots of flaws besides, what we'd see in a traditional one of these. So it's not the best facts to say highest and best use, essentially doesn't work, or discounted cash flow doesn't work. It's the way the tax court's kind of going. But you weren't going to get the tax court overturned on this case because it just had so many ways to kick it out. Okay, finally, I forgot to put this on my main introduction slide, but it's here. The IRS updated digital account reporting FAQ guidance, right, this week. It issued compliance under Section 6045 and Treasury Regulation 1.6045 for digital asset brokers. This is on the FAQ on the IRS website. Reporting obligations for dispositions of digital assets are effective for transactions occurring on or after January 1st of 2025. you're going to receive these notices on Form 1099-DA. So essentially, this year, for the 25 returns, you'll begin to receive 1099-DAs from various brokers who are handling these sales of digital assets, primarily cryptocurrencies. It could be non-fungible tokens, NFTs, although that market seems to have expanded, got huge, and then totally collapsed within a few months. So I don't know how many NFTs are going to have, although NFTs were out there when this thing got passed. So it does deal with them. Broker obligations are limited to sales transactions the broker actually affects for its customers, right? So if you're operating digital, so that means they got to be ones you actually affect. So an example they would give is, for instance, transferring funds from your broker account to, in Coinbase, whatever, to a third party who then would send you cash directly. That would not be one actually affected for the customers. Rather, you ordered, let's say, Coinbase to sell your crypto. That's a totally different thing, right? They also said any business operating digital asset kiosks that affect sales or exchanges are explicitly defined as digital asset middlemen that are subject to reporting. You may have seen these, Bitcoin ATMs. You basically put your Bitcoin in, you give the keys to it, and it then will cash that and give you cash out. Those have to report. This is going to get way more interesting, right? Those kiosks, therefore, are supposed to be collecting the information required, which will include identification numbers of the taxpayer, address, identification number, etc. That's going to complicate those quite a bit. But they said, look, they are digital asset middlemen. They are taking the coins, they're putting them on deposit, and then they are essentially, giving you cash. They're holding the middleman concept. So they're there. Okay. Now, permitted use of brokers permitted but not required to use customer-provided acquisition information, like from transferring from a custodial broker, solely for lot ordering, identifying which units were sold. Treasury Regulation 1.6045, 1D2. Go a little deeper, and you'll find the detailed line there. But a broker cannot rely on customer-provided acquisition information to report the customer's basis on a 1099-DA. Right? So they're going to report basis on ones that they acquired for the customer and then later sold. So if you use any customer-provided acquisition information for lot ordering, you must check box 8. If you relied on customer-provided acquisition information to determine the order of sales. Okay? That'll be on the form. Covered digital assets are those purchased on or after January 1st, 2025. Non-covered assets are those purchased prior to that date. Okay? A single transaction involves both covered and non-covered assets. This is just kind of like what we had for various securities. And the broker voluntarily reports the basis of the covered assets on a single 1099-DA. You may not check box 9, non-covered security. So in essence, if they have both, they have a single sale and they don't break it into two, and they voluntarily put base information down, they're not going to be able to say it's non-covered because they're going to have to report that to the IRS, is what they're saying. Consolidated reporting requirements subject the brokers to potential penalties under 6721, 6722, which we talked about earlier regarding the reporting for wages, for the tips and the tips and overtime. If voluntary reported non-covered basis is incorrect. Okay. So that's why you might not want to do it. Okay. When we do that. If you voluntarily report non-covered basis incorrect, you would be held potentially penalties for that. So I have a feeling they're saying don't do that. Penalty relief. To secure relief for voluntarily non-covered basis reporting, you must file 2 separate 1099-DAs. Box 9 may be checked only on the one with covered assets. So what they're saying is what we already see, right, from brokers now. If somebody, let's say, had a security mutual fund that they held before they required them before they were considered covered, and we've had acquisitions since they became covered securities. You'd always see on your brokerage statement, part of them would be in the covered security sales and part would be in non-covered. Technical transaction fees, they have some more guidance in there in the FAQ. If an exchange occurs, unit used to pay the transaction fee is withheld from the digital assets received. The broker is not required to report the sale of that fee unit. So essentially, in essence, if you withhold it from the digital assets received, then we don't need to report the sale of that unit. Sales of newly minted NFTs require gross proceeds reported only in Box 11C, while sales of previously specified NFTs use Box 1F, right? Because it's going to be basis reporting whether you know it. 2 separate 1099 DAs required in a combined sale. We have some that are covered, some aren't, same issue. There's also going to be a test for qualified stable coins. If you have those which don't need to be reported, they're going to say basically the unit cannot fluctuate by more than 3% over any consecutive 10-day period during the year to still be a qualified stable coin. It can have variations, but it can't be more than 3% over any consecutive 10-day period. If it is, then you're in trouble, right? You're not going to be able to use it. Very only occurs if the unit fluctuates by more than 3% on at least one trade on each day of that consecutive 10-day period. They have that test. Well, it's November the 10th week. This has been Current Federal Tax Developments for the week of November 10th, 2025. Remember, if you have not-for-profits, we're coming up on the last calendar year, basically extended due date for a tax return in the 990s, are coming up. If you extended them, we're going to our one last try. I don't really do those, so I'll leave that to the rest of you, but you got that in there. As always, you can email me, edzollers@currentfederaltaxdevelopments.com to discuss, what you have any questions. I do participate on the Connect sites for the Arizona Society of CPAs, for the Idaho Society, New Jersey Society, Illinois Society, Minnesota Society, and Washington Society. So if you have anything there, you can post there. If I see a question, I think I might be able to answer it, I may pop up and say something. So you can do that. Otherwise, just kind of keep an eye out. We will see you here hopefully next week. Now, next week is a potential complication for me because we are moving offices. And we are last day in the old office is this coming Friday, the 14th. And officially, first day in the new office is the 17th, which means we're going to be probably doing a few things over the weekend to be ready to hopefully be able to kind of get started on the 17th in our new location. So what I'm trying to say is the upcoming week's update could be a casualty of the move. Hoping not, but it could be. Because again, I've got a few things to take care of, a few things to happen, and we got to get everything moved over and hopefully in decent enough shape that we can be running on Monday in the new building. So all there. So those of you, it's basically about a mile away from our current office here in Phoenix. Just relocating, don't need quite the amount of space. My partner owned the building, so decided this might be a good time that he could get rid of it. He could do that. We don't need the space. He's therefore doesn't worry about, what happens when we all retire. And is he stuck with the building? And he's got to find somebody to lease it to. So we got a few things out of the way there, right? Need structure. So anyway, we're down there in a building that's owned by the State Bar of Arizona, which is even more interesting in some ways. So we'll get there. But we'll see you all hopefully not next week, then 2 weeks in any event here on the future version of Current Federal Tax Developments.